Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. In my recent previous commentaries, the main feature here since late February had been the imperfect bear channel, currently at 1574 to 1820. The lower bear channel line had been pretty good support in the past, but the upper bear channel line, well, that had only had the two touches on it. And when tested in late June by a small late May to mid-July rising expanding wedge pattern, it gave way relatively quickly, with prices rising up through the stratified congestion levels at 2003, 2047 and 2069 to 2076, peaking at the latter as well as at the descending medium moving average at the time, which is currently 1974. It was, as I said 5 weeks ago, and I quote, the general zone between 2100 to 2010 has seeming a lot on top. And that's the end of the quote. By the way, I also include the previously mentioned August 2020 to date broken uptrend, which is currently at 1992. Bright green highlighted August 2022 to date uptrend, currently 1905. These two broken uptrends did not act so much as resistances, more as nuisances. The subsequent decline fell down by the same old support we saw in late May and early June, and now 2 weeks ago as well, at the significant 21st century 50% absolute Fibonacci line at 1809. Prices pulled back up a little that week and last week, up over the very ineffectual upper bear channel line, but saw the action capped in the middle of last week in part by the nuisance bright green broken uptrend, but I suspect more fully by the purple upper tine, currently at 1919 of the late February to very early July bearish Andrews pitchfork. I drew this bearish pitchfork last week in the hope it might provide some idea of the recent bearish angle of attack. I did mention at the time that I would be happy to finesse this to a shallower bearish shift pitchfork for the same move, if it became appropriate, but right now it seems there is no need for this finessing. We're at this time between the upper tine above, currently at 1919, and the middle tine below, currently at 1672. Another point I made last week is a longer term one. I pointed out that we had the opportunity to have a monthly key reversal in July. Price has almost made it, but not quite, instead opting for the lesser outside month pattern in July. The final idea put out there last week was to perhaps regard the action since mid-April forming a possible double bottom. Last week, as the phrase implies, this pattern was not complete, and we would need to see how the action develops over the next few weeks. Excuse me, I was very clear on the wording on this, and I quote, please note this is a potential for a double bottom, not a potential double bottom. Potential for, not a potential double bottom. The distinction between those two is very fine but definite. End of quote. Well, this week the idea is further away and I'm considering dropping it altogether. This really just leaves the purple highlighted bearish Andrews pitchfork as the main operational pattern in this market, and the one pattern that was formed last week, a weekly key reversal down. Ice Europe, white sugar in London. The changeover gap in mid-April between 613.40 down to 580.30 saw prices exit various stratified levels and go on in late April and mid-May to form another different pattern, a bearish descending triangle pattern. Currently that's 600.80 to 624 even, and it's highlighted in bright red on my daily chart. The exit below and out of this pattern in mid-April gave us a primary target in a 544.80 zone and a secondary much harder to reach target down in the 497.60 zone. 12 weeks ago, prices moved down and reached the primary target by the means of a mid-April to mid-May bear flag. The activity in heading lower, much like New York sugar, allowed me to draw a new pattern and speculate on two other outcomes. I hasten to add, actually, the secondary target X1 at 497.60 for that pattern is still there. Anyway, Firstly, I drew last week a start of April to start of July bearish Andrews pitchfork highlighted in purple on my daily chart. The market is presently in between the overhead upper time currently at 544.60 and the middle time below currently 475.40. Much as in New York Sugar, I've been hoping this might provide some definition to the recent bearish angle of attack, and I was willing to finesse this to a shallower bearish shift pitchfork for the same move if it became appropriate, but right now it doesn't seem that I need to. We're at this time below the upper time, currently at 555.5, and above the middle time, currently 486.30. Another point I made last week is a longer term one. I pointed out we had the opportunity to have a monthly key reversal in July. Prices did indeed create a monthly key reversal down here in July, and though it is a longer term pattern, we have already seen a suitable follow-on lower since the start of August, with prices down to levels not seen since March 2022. The final idea I put out there last week was to perhaps regard the actions since mid-April forming a possible double bottom. Last week, as the phrase implies, this pattern was not complete, and we would need to see how the action develops over the next few weeks. I was very clear on the wording of this, and I quote, "Please note, this is a potential for a double bottom, not a potential double bottom. The distinction between those two is very fine but definite." End of quote. Well, this week the idea is much further away, and I consider it dropped. This really just leaves the purple highlighted bearish Andrews pitchfork as the main operational pattern in this market. So what have we in the way below that might hold up any declines? Well, we have a band of congestion between 509.5 to, where are we? 517.80, which is being tested now. Most of it is 1 to 3 years old, but we also have some congestion from 2017. This also applies to the thin 490.10 to 489.10 congestion further down, just below target X1. Yeah, the one that's still live. We then have the neckline extension to the April to June 2021 head and shoulders neckline, currently at 480.90. I'm not sure how good this is, but I've highlighted in dark blue on my daily chart, so I must think there is something behind this. The only final thing I'd ask you to bear in mind is the pattern from last week, and that's a weekly key reversal down made last week. Sugar white premium spread. I had previously spoken here some while ago now about a big picture item seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021 highlighted in dark blue on my weekly chart, with the lower time currently at 145.5, tested, breached, now broken on the downside. 16 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to the London sugar month changeovers, but it nevertheless set the tone for a lower market, though prices took their own sweet time in getting down below the lower time, and that's not a pun, that's just a phraseology. So we are now testing the lows of early to mid-October last year, down in the 115.75 to 116 even zone. Indeed, where we have been late last week and earlier today as the next support, that's where we've been down to that 115.75, 116 zone. As the next support, though, when prices were down here back in October last year, they were at the same time, so those levels were at the same time just above the dark blue lower time, which they are not today. Hence, this support may not be as strong today as seen back then. Overhead, we have the two 50% Fibonacci lines of the July 2019, the September 22 move at 131.25, and the August 2021 to September 22 move at 128.75. There are lesser Fibonacci lines below, further below, at 107.75 and 104.5, but I am not sure how good they are. The next support now will be the lows of the first week of February 2023 at 83 even, the mid-February low at 83.75, and the early February low at 81.75.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.